is Vidhi Kalra and welcome back to my channel 5 Minute Economics, where I teach economic concepts in a span of just 5 minutes. So today's video is called the monetary policy. So often we tend to read about the monetary and the fiscal policy in the newspaper, but do we actually know what are they and when are they implemented and what's the difference between the two? So in today's video, I'll be talking entirely about the monetary policy, and definitely soon I'll be coming with another video called the fiscal policy. So yeah, let's get started. So firstly, let me tell you what exactly is the monetary policy. So monetary policy is the demand side of the economic policy, which is implemented by the central bank of a country. In India, of course, it is implemented by the Reserve Bank of India. And why do we need a monetary policy? We need a monetary policy so as to ensure that there is economic stability in a country, there is price stability, and most importantly, that there is sustainable economic growth. Moving to the types of monetary policy. So basically, there are two types of monetary policy, the expansionary and the contractionary. First, let me explain you what exactly is the expansionary monetary policy. So basically, an expansionary monetary policy is implemented by RBI when they see that there is an economic slowdown in the economy, or when an economy is going through a phase of recession, they want to revive the economy. So for doing that, they will lower the rate of interest. Now, since the rate of interest is pretty much lowered, it is unfavorable for people to save. They will rather want to spend the money. In fact, they can take loans from the bank because rate of interest is pretty much low, and they can use it for their productive activities. And in doing so, they will increase the money supply. There will be more money they will spend on productive activities, and the economy can thrive back. So this is expansionary monetary policy, and it was implemented during the 2008 financial crisis so that the economy bounces back to its normal. So the contractionary monetary policy is just the opposite of what we studied in the expansionary monetary policy. So when is this implemented? It is implemented when there is too much inflation in the economy and the RBI wants to curb the money supply in the economy. That's when we implement this. What happens is just the opposite. We tend to raise the interest rates. Now when the interest rates are very high, people tend to spend less, and in doing so there is a curb in the spending, and it decreases the money supply in the economy. So it brings that necessary needed slowdown. This was done back in 1980s when the Federal Reserve had to raise the interest rates to a record high of 20%. It had to do so to bring that slowdown in the economy. So this is all about contractionary monetary policy. So moving further to the tools of monetary policy. So monetary policy basically has three major tools: the open market operation, the bank rate, also known as the discount rate, and the CRR, which is the cash reserve ratio. So basically, what is open market operation? Open market operation is the buying and selling of the short-term bonds by the central bank, chiefly to the commercial banks. So what happens is that when the RBI wants the money supply to increase in the economy, it tends to buy the securities. Now when they have bought the securities, they have injected money in return, and thus people will have more monies when the commercial bank will have more money, and they can do productive activities. Whereas when it wants to curb the money supply, it tends to sell the securities. Now when it has sold the securities, it has absorbed the excess money supply from the economy. Secondly is the bank rate or the discount rate. So we know the central bank doesn't directly deal with the public, but it deals with the commercial bank. So bank rate or the discount rate is the rate of interest charged by the central banks to the commercial banks. So what happens is when the central bank wants that there is more money supply in the economy during an expansionary monetary policy, it tends to lower this rate. Now when this rate is lower, when the rate of interest is lower from the central bank side, now the commercial banks can also lower their rate of interest, what they charge to the public, and there can be more money supply in the economy. While vice versa conditions prevail during a contractionary monetary policy, they tend to raise this discount rate. Thirdly is the cash reserve ratio, which is very much in the news lately, and we've all been reading about it. So basically it is the funds which the commercial banks have to keep with the central banks as an emergency condition. Okay, so basically when the central bank wants that people have more money, it tends to lower this rate. So when this rate is lowered, so commercial banks have to keep lesser amount with the central bank, and they have more money with them so that they can lend to the public. And during when there is excess supply in the economy and it wants to curb that, it tends to raise this CRR. So basically these are the three tools of monetary policy. So lastly, I'll be explaining you about the liquidity trap in brief, without which the explanation of monetary policy is incomplete. So basically, what is a liquidity trap? Liquidity trap is an extreme condition of a monetary policy, and it occurs during the time of a depression. So what happens is, at this time when the economy is in a liquidity trap, the rate of interest has fallen so low that people will rather tend to prefer to hold cash rather than to invest in bonds. It is the case when the monetary policy, the expansionary monetary policy, has no effect. And to take out the economy of a liquidity trap, we tend to then use the fiscal policy. So this is all about the monetary policy, guys. I'll definitely be coming up with another video on fiscal policy and the differences between these two. So I hope you like this video. Please do like my video and subscribe to my channel, and hope to see you in the next video pretty soon.